Good morning, folks, and I apologize. I was out for a couple days. My wife was having some eye issues just like me, and I was taking care of her. So I am back, and it is Fed week. So today we're going to talk about what the Federal Reserve does, what they're expected to do, and let's get a little guidance on what they've done over the last maybe 3, 4, 5 years to put us in this position. So without further ado, let's get over to that because this week the Federal Reserve is going to determine if they're going to raise rates once again. So let's skip through this right now. Let me give you guys a little education on what the Federal Reserve does and how they control the monetary policy. Then we'll get back to see what's going on in the economy today and what that news is doing for interest rates. So the first thing we want to do is go over to right here. The Federal Reserve is expected to meet this week, and they're not expected to. They are meeting this week, and they're going to determine if they're going to increase rates or not. So here's what the Federal Reserve does. They control what's called the federal funds rate. All that is basically interbank lending. If one bank needs money, they go to another bank, they lend money to each other, and they lend it on a rate that's called the federal funds rate. It's not a rate that you and I pay. It's not like affected to your credit cards and things like that. But the definition is the Federal Reserve doesn't set mortgage rates, but its actions indirectly affect mortgage rates. As of its meeting on March 22nd, 2023, the Federal Reserve has raised the benchmark interest rate by a total of 475 basis points or 4.75%. That is huge. So let's get over to see some of this information. So what the Federal Reserve did last year, because we saw inflation getting out of whack, they did this. And this was unprecedented. They never did this many times. That's what I want to show everybody. So what they did is they started back in March of 2022 and they raised rates a quarter, then 50 basis points. So these 50s and that thing, this is a percentage. So that's 25 or 0.25%, 0.50%. So that would be a 0.5%, 0.75%. So you can see how much they've risen rates over the last year and a couple months. We basically went from almost zero. You can see down through here. Let me see if I can just scroll this up a little bit. We're at zero. And where are we today? About 5%, and they're expected to go over 5%. What they expected to do in this week's meeting, here's what the probabilities are for the Federal Reserve to raise rates once again. So where we are right now is right here at 4.75 to 5%. That is the federal funds rate currently. Where is it expected to be? Well, in the meeting coming up right now on May 3rd, the probability is 95% that they're going to raise rates to 5 to 5.25. That means they're going to raise rates another 0.25%. But then the good news from there is look at the probabilities going forward. Basically, we're sticking right at 5 to 5.25. And then these numbers start to come down. They're saying, well, we're going to stay there for probably several meetings. And then what we're going to do from there is start tapering off. That means the Federal Reserve is expected to start reducing interest rates. So let's get over to the patterns that they've had in the past. So let's go back through to here. Here's what we've come off of. So just recently, back in 2020, the Federal Reserve actually reduced rates by 1.5%. You can see that right here. Okay, in 2 quick meetings. Now, they usually don't do inter-meeting rate adjustments, but they did here. Okay, so less than, let's say 3 years ago, they actually dropped the federal funds rate to zero. Okay. Since then, they've been jacking it up all the way to the moon. Well, what actually caused all this? Information received since the Federal Reserve open meeting in December is basically it's all caused by the COVID and a COVID recession. So think about it. The Federal Reserve stepped in to stimulate the economy because everything was shut down. Employment was shut down. The whole ball of wax everything was closed. Okay. So to stimulate the economy, they basically said, we're going to take rates to zero to help stimulate the economy. And then they kept basically reducing it and they reduced it to zero. So is that prudent or is it not? Don't know. But let's go back a little bit further. In 2019, they were also reducing the rates. Okay, so since 2019 and 2020, you saw the Federal Reserve basically bring down the federal funds rate to zero. Did they overshoot? Don't know. Okay, but where we are now, because of the pandemic and the flush of money into the systems, well, this is what's happening. And the Federal Reserve is destined to basically shut down inflation. So this is what they're doing to basically slow down the economy. Okay, are they overshooting? I think they're going to overshoot because they've overshot the last 5 times that they've done all this. So without further ado, with that coming in, let's look at some economic news that's coming in this week that might also play a role in the economy. So what we go through right now is let's look at manufacturing, let's look at employment, let's look at some other inflationary numbers. Let's drive down those to figure out, where are we going from here? So we look at the manufacturing numbers, and the first thing you're going to think is, well, didn't the Federal Reserve say we need to get into a recession, or we're trying to avoid a recession, but we really need a recession to really halt the inflation numbers, okay? So what you're seeing on your screen right now is what's happening with the manufacturing numbers. Well, this kind of threw the Fed a curveball yesterday, because the expectations were, the previous readings was manufacturing is, let's say it's at 46%. Okay, the expectations were to increase just a little bit, but they went from 46.3 to 47.1. That's a pretty big uptick in manufacturing, especially when the Federal Reserve is saying we need people to lose their jobs. We need manufacturing to really start reducing. We need to go into a recession to stop the inflation. Okay, so this number here, this reading here doesn't tell it. Okay, what we have to figure out is, if this news keeps coming in better and better and better, the Federal Reserve is going to sit there and say, we need more, we need to do more, because our goal is to, remember not too long ago, they said we're going to crush the economy. That's exactly what they said. Okay, so the next number that comes in is the JOLT index. You guys might hear me every once in a while talk about the JOLT index, and you might not really know what it is. Basically, think of it as this. How many job openings are there in the U.S.? How many job openings? We have 9.5 million job openings, but just 60 days ago, we were at 11 million. So does that mean more and more and more people are getting jobs? No, not really. That just means employers are not looking for as many employees, because they're expecting, CEOs throughout the whole country are expecting a recession this year. Okay, and all the numbers are pointing that way. So this kind of is in that same realm. And then let's go to Wednesday. Again, we want to look at the employment numbers and other inflationary things that we can look at. So the ADP farm or non-farm payroll numbers, these are people getting new jobs. Well, the previous reading was 145,000 new jobs in the last reading. They're expecting that to uptick to 148. Not good news there. Let's go through here. Manufacturing, they're expecting it to increase all across the board. Crude oil inventories, we're going to disregard that right now. Fed interest rate decision, we're currently at 5 right now, the federal funds rate. It's expected to go to 5.25, and I'm going to be in agreement at that. And then we start getting more numbers on the employment numbers. But these are after when the Federal Reserve comes out with their numbers. So these are going to be, I hate to say, irrelevant for this time period, but it will be relevant going forward. And then we got Thursday, we got initial jobless claims, how many people got let go. And you can see right here, they're expected to go from 230 to 240. That might not be the case. And then we got Friday unemployment rates and non-farm payroll. ADP comes out with a payroll number here. I usually don't really monitor it because they're really never even close to the numbers. But I'll give you those numbers as they come in. So without further ado, what's all this information doing to the markets right now? Well, let me show you my screen. So to give you some context, then I'll go over to mortgage rates. So what you're seeing on your screen right now is the MBS market is up 5. Basically nothing. We got hammered the last few days, and I'll go over that with you in rates here in a second. And we got the 10-year treasuries basically down 0.07. So that's a pretty decent move right there. So let's go over to figure out what's going on with mortgage rates based on all this. So we had a huge uptick in mortgage rates yesterday. So if you're locked in, kudos to you guys. If you're not locked in, you just missed out a nice little run or a nice little rally with mortgage rates. Everybody's positioning themselves right now for the Federal Reserve, what they're going to do. You guys have some insight on what's going on with that, because I gave you those numbers right through here. A 93% probability the Federal Reserve will be increasing rates by 0.25%. Because you watch this video, you know that mortgage rates aren't going to go up 0.25%. And I'm going to give you a free gift at the end of this video. All right, so here's the top 6 products that people use when they're buying or refinancing a home. These are mortgage rates published by Mortgage News Daily. Now, I want to make clear, these are not any bank's mortgage rates. What Mortgage News Daily does on a daily basis is they survey mortgage lenders all over the country and say, if you had a person buying their first house, 740 credit score, putting 20% down, it's their first house, it's a single family home, what would the rate be? Here's the top 6 products that people would use. So these are the averages out there. But remember, guys, 740 credit score, 20% down, and these are the averages. These aren't your rates. So to find out what your rate would be if you're looking for a mortgage or trying to get pre-approved, please visit my website at therateupdate.com. I'm a mortgage advisor. Love to help you. I'm licensed all over the country. If you want to reach out to me directly, you can find my information down below. So thanks so much for watching, guys. I'll see you tomorrow. God bless. Have a fantastic day. Bye-bye.